So Meredith, your latest State of the States report, it looks at 25 of the biggest states, and what you essentially conclude is that their deficits are much larger than the official numbers show. So the situation's much worse than everyone thinks it is.
Well, not only did we look at 25 states, but we also took a much more comprehensive look at the finances in general of the states, adding on analysis of legislative expediency, adding on in-depth and unprecedented analysis of the off-balance sheet liabilities. These are 09-010 pension obligations, OPEB, which is other pension, other post-employment benefits. These have equal weighting and equal claim to the tax receipts of a state as government or general obligation bonds. So all of this add in, like the pension funds and the OPEB liabilities are 75% of the total debt of the states. General obligation bonds are only 25% of the states. So if you look at the totality of it, the debt situation is far worse.
What state to you stands out looking at these 25 now, half of the United States, is in the worst situation, especially when it comes to those off-balance sheet liabilities, because those are numbers that haven't been accounted for until recently.
Right. Well, what has happened, so the root of all of this is states have been spending at least 2 times what their tax receipts have been for over a decade. And in some cases, they've been spending 3 times their tax receipts.
And through the recession.
And through the recession. So how do they do this? They're supposed to 49 states are supposed to report balanced budgets. What they've been doing is either they've been looting rainy day funds, or they have been issuing government general obligation debt, or they've been raiding their pension funds. And by raiding their pension funds, you just kick the can of debt obligation to future generations, effectively generational robbery. To your question, who looks the worst? New Jersey looks the worst because they've been doing it for the longest. So they've been underfunding their pension for the longest.
Less than a year ago, you came out with the first report with 15 states. Now we have 25. How much worse has the situation gotten, and has it improved in any state?
When we published on 15 states, we just took the off-balance sheet liabilities as is. And so we took existing numbers. They were 2008 numbers. Since that time, we updated those numbers, and this was really yeoman's work, 2009, 2010. So unfunded pensions grew by 50% in 1 year's time.
In 1 year?
1 year's time.
So this is sort of an uncontrollable, out of control problem at this time when you look at underfunded and unfunded pensions.
Right.
So is that what has to change? Is that what has to go in these states?
I think there are a lot of things that have to change. There's going to have to be concessions on all sides. Look, there already have been. You've had state employees take concessions. The biggest issue is you've had taxpayers take the heaviest concessions, which is their taxes have either gone up and had this reduced social services, or their taxes have stayed the same and they've had reduced social services. They're paying equal or more for less.
Is this a new reality? I mean, is this what people are going to have to swallow, that pill, for the next, say, decade to get the books back in order?
There's no doubt about it, because what you've had is, look, the consumer has corporates have done a great job of delevering, and corporates now are in a great position. Consumers are in the process of delevering. The states have not delevered. In fact, state spending has grown in excess of 35% what consumer spending has grown for the last decade. So people talk about reckless U.S. consumers. The states have been far more reckless. So it's an issue of they've got to get their houses in order. And it's very easy for someone to move from New Jersey to Pennsylvania because of tax favorability. Social mobility is much easier, and that's the real risk. So you have the risk of state arbitrage.
Let's talk about that. It's a very interesting point. State arbitrage, essentially saying, people will leave states that are already in a bad position financially and go to other states that are, say, more business friendly, a Florida, a Texas, for example, and that just makes the situation spiral and get worse.
Right. So let's look at, as an example, let's look at California. You have businesses that are headquartered there that are building facilities outside the state. A state like Washington, you're getting Boeing trying to build a new facility in South Carolina. You have Florida as an example. Florida has been hit so hard by real estate. You have population migration outside of moving outside of Florida. What that means is the revenues that were supposed to be supporting these projects fall even further, and taxes then have to rise even further. So you have the group of people who are your deepest tax base leave. You're stuck with a group of people who have a lower tax, capability or wherewithal, and so you've got less supporting more.
Last year, you predicted that hundreds of billions of defaults is what we'd see in muni bonds over the next 5 years. Does this evidence from this report support that theory more? Do you still believe that that's the case, hundreds of billions?
I think the number is going to be really big. I think that that was what it looked like to me at the time, and things have gotten worse. I'm not saying that the number will get worse. It's just there is not a lot of optionality for these states. Too much leverage was put into the system that cannot support the leverage anymore.